Welcome. So, you've mastered the investing basics, right? You've got an emergency fund, you're contributing consistently, you understand how compound interest works, and now you're probably asking yourself, okay, what's next? Well, you're in the right place. Today, we're building that next level playbook for the intermediate investor. Let's get into it. You might feel pretty good about your portfolio. Maybe you own a big market index fund, like one that tracks the S&P 500. You've heard the advice, buy the whole haystack. But what if that haystack is, well, secretly lopsided? You might not be nearly as diversified as you think. Get this, roughly 30% of the entire S&P 500's value is concentrated in just 7 giant tech stocks. We're talking about the Magnificent Seven: Apple, Microsoft, Amazon, Nvidia, and the others. That means almost a third of your diversified investment is riding on the performance of just a handful of companies. And that, my friends, is the definition of concentration risk. It means your performance is super dependent on these few giants. I mean, if they're soaring, you're doing great. But if they stumble, they can drag your entire portfolio down with them, no matter what the other 493 stocks are doing. It's time for a more resilient strategy. So how do we do that? How do we build a portfolio that's truly built to last, one that can handle whatever the economy throws at it? We've got to move beyond this simple top-heavy approach. Let's start building your new, more sophisticated playbook. Okay, our first play is all about moving from just a basic index fund to what we call a strategic multi-asset allocation. It sounds fancy, but it just means we're going to intentionally own different types of assets that behave differently. This gives your portfolio way more stability and a lot more ways to grow. So a typical beginner portfolio, think the classic 3-fund model, is super simple. US stocks, international stocks, and some bonds. And look, that's a fantastic start. But the intermediate portfolio, the one on the right, well, it gets way more granular. It adds specific asset classes to target different economic drivers. And here's a great visual of what that could look like. See, instead of just one big fund for US stocks, we're strategically adding a dedicated slice for small cap stocks, smaller companies that have more room for explosive growth. And we're adding another slice for real estate, which is great for income and can help protect against inflation. So the whole point here is this: you are building a portfolio with multiple engines. You're no longer just a passenger on the large cap tech train. By adding small caps, real estate, and other assets, you're creating a much more balanced machine that can perform well whether the economy is booming, slowing down, or even fighting inflation. All right, let's talk strategy number 2. Having a static portfolio is good, but an intermediate investor knows the market isn't static at all. It actually moves in cycles. And if you can understand where we are in that cycle, that gives you a huge edge. The economy doesn't just grow in a straight line forever. It kind of breathes. It goes through these phases of expansion, it hits a peak, it contracts during a recession, and then eventually it recovers. And here's the key. Different parts of the market, what we call sectors, tend to lead or lag during each of these phases. This is basically your cheat sheet for economic cycles. Check it out. During an early expansion, when things are just starting to heat up again, sectors that are sensitive to growth, like technology and financials, often do the best. But then you shift to a recession, and the smart money flows to defensive areas like healthcare and utilities. Why? Because people still need electricity and medicine no matter what the economy's doing. This idea of tilting your portfolio toward the sectors that are likely to outperform in the current economic phase, well, that's called sector rotation. And look, this isn't about timing the market perfectly. Nobody can do that. It's about aligning your investments with the big economic trends. It's about giving yourself a tailwind instead of trying to fight a headwind. All right, for our third and final strategy, let's borrow a simple but really powerful tactic straight from the pros. This is a rule they use to avoid emotional mistakes and unnecessary risk, and it's one you can easily start using tomorrow. So just think about a typical trading day for a second. When do you think the volume is the highest, the price swings are the wildest, and the most emotional, knee-jerk trading happens? When is the market the most dangerous for most of us? Yep, the opening bell. That first 30 minutes of the trading day, from 9:30 to 10 a.m. Eastern, is absolute chaos. It's when the market is trying to digest all the news that happened overnight. It's full of extreme volatility and what pros call panic money. In fact, a lot of professionals just sit on their hands and watch during this time. So the pro takeaway here is really simple: patience. For most of us who aren't day trading for a living, Just avoiding making any moves in that first half hour can be a total portfolio saver. Let the initial craziness die down, let the market figure out its real direction for the day, and then you can think about putting your money to work. Okay, so we have covered a lot of ground here, right? We've gone from understanding the hidden risks in a beginner portfolio to laying out 3 distinct strategies to level up your game. Let's put it all together into one clear, actionable playbook. Here it is, your new 3-part playbook. First, move beyond that basic index fund to a strategic multi-asset allocation. Own different engines of growth. Second, learn to read the economic cycle and tilt your portfolio toward the sectors that have a tailwind. And third, practice a pro's patience by simply avoiding that chaotic first 30 minutes of the trading day. These 3 strategies will fundamentally change how you invest. Seriously, by moving beyond a simple index, by aligning with the economic winds, and by being patient, you're not just a passenger anymore. You're becoming the pilot. So now the journey doesn't stop. The next step involves learning the tools the pros use, not just for growth, but for protection too.